This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So we're going to go through and look at deferred tax. To introduce what deferred tax is, I think it's best to think about what we've done previously with regards to tax, which was all seen, wasn't it, in F1. So in F1, we worked out the current tax, which was an estimate of what we owe to the tax authorities at the end of the year that we recorded as a current liability, didn't we? We then took that current liability and then used it to work out the tax expense, whereby that tax expense was the estimate of this year's liability that we then adjusted for, wasn't it, for any under or over provision from the previous years, wasn't it? Okay, so that's all been done. That's in the past. We don't change anything of what we've done within the past. The liability still stays there on the statement of financial position. However, the key aspect that we have is when it comes to the expense, and that's where deferred tax starts to kick in. So let's think about what deferred tax is. Deferred tax, by definition, there says it is the estimated future tax consequences of transactions and events in the financial statements of the current and previous period. So the transaction and event needs to have taken place either this year or in previous years, and then the tax impact of it is in the future. So what we'll see quite a lot of is we make adjustments due to the fact that we buy an item of property, plant and equipment, and we charge depreciation in the financial statements, but the tax charge is based upon capital allowances. So the future tax consequence is the difference between the capital allowances and the depreciation, or if you like, the accounting depreciation and the tax depreciation. And what we're going to do is we're going to do something about it within the financial statements today. Okay, so even though it's a future tax consequence, we're going to adjust for it today. And we'll see why as we work through the example in the following session. The key thing, however, is when we account for deferred tax, we don't pick up the phone and ring up the tax authorities and say, excuse me, you do things differently based on your tax rules compared to what we do under the accounting rules. So we're going to pay you something different to bring things in line with our accounting rules. There'll be a shout down the phone, which essentially says, what are you on about? Go away. Okay, you're talking nonsense. Yeah, so what we did in F1 with regards to the current tax still stays the same. The key bit about deferred tax is that it is not a tax payable to the government. It is purely an accounting entry. That's all we do. We just debit something and credit something. So we adjust the statement of profit or loss and then begin to look at this deferred tax balance on the SFP. We do not, and I repeat, we do not, understood? Yeah, we do not change the tax payable balance. Whatever we've calculated as the tax payable balance to the tax authorities remains. We don't change it. But we're accountants, so we like to change things, and we change things within the financial statements, okay, with regards to deferred tax, the future tax consequences that we account for today, okay. So why does deferred tax arise? Well, it arises because the accounting profit, PBT, is not equal to PCTCT, so profits chargeable to corporation tax, which is your taxable profits. So we have an accounting profit figure, and we'd like to see that accounting profit figure used to work out the tax expense. The issue that you have, however, is that the tax expense is based upon your taxable profits. Your taxable profits are calculated on different rules, aren't they? And those different rules will therefore mean that we don't start to look at the matching concept with regards to seeing an expense in profit or loss with regards to depreciation, and then seeing the benefits of that depreciation through our tax charge. We see the benefits of the tax depreciation, don't we, or those capital allowances that go through our tax charge. So we're going to have to start making adjustments to the expense to reflect the future tax consequences. Okay, it all sounds quite tricky, doesn't it? But the example shortly will pull it all together. So the key bit to take from this point here is that deferred tax arises due to differences between accounting profit and taxable profit, because the tax authorities use their tax rules. We use accounting rules, don't we? Okay, so why do those differences arise if we're looking at accounting profit versus taxable profit? First one that we have are looking at your permanent differences. And permanent differences are one-off differences between items that are not taxable, or if you like, are not tax allowable. Okay, so we may have an expense. An expense will go through PBT, but it will not go through PCTCT, your taxable profit, because it is a disallowed item of expenditure. So there is a difference, but there is no future tax consequence to it because the tax authorities do not allow that expense. It could be that you've accrued some income in PBT, but that income is not taxable or tax allowable within your PCTCT. So you see the profits, but you don't see any tax on those profits because the tax authorities do not tax that income. Okay, so there is a difference. It is permanent because it will never ever be taxable or never ever be tax allowable. Okay, if that's the case, there is no deferred tax consequence because there is no future tax to account for. Okay, the prime examples that you've got are client entertaining, because client entertaining is an expense, but you don't get a deduction, do we, within your taxable profits? Otherwise, everybody be taking their clients out all year and paying no tax, and that wouldn't really work, would it? And the other one here in the UK is your UK dividend income. You get your UK dividend income. It goes into investment income in your in your accounting profits, but it will never get taxed under your taxable profits, or at least it wouldn't, based on our UK accounting tax laws. So permanent differences, if there are any, no deferred tax. So the next difference must have deferred tax within it, and that's referred to as a temporary difference. Essentially, a temporary difference is whereby something goes through PBT 1 year at a determined rate, but goes through PCTCT at a different rate. So there is a difference between the tax treatment and the accounting treatment in the year. And what will happen is that these differences will go through there and cancel out over time. Okay. So as those differences cancel out, there will be future tax consequences, won't there? Because there's a difference between the tax and the accounting treatment. But overall, because we get the same benefit over time, there will be a future tax consequence. So there will be a deferred tax consequence that you have to go through and account for. Remember, it's an accounting entry. The two scenarios that I'd like you to be on the lookout for, I say two, normally only one that we see, is the differences between depreciation and capital allowances. If you buy an asset for $5 million, you will claim that $5 million over the life of the asset via depreciation, won't we? So if it was 5 years, then it would be $1 million per annum. But there is a difference between the accounting treatment and the tax treatment. The tax treatment allows us capital allowances, or your tax allowable depreciation, doesn't it? And the tax allowable depreciation still allows you to claim that $5 million, doesn't it? But what the tax rules try to do is to try and give you more allowances in the earlier years, don't they? To try and incentivize you to buy those non-current assets, so that therefore you will get a lower tax bill in the earlier years, and therefore buy more non-current assets and more investment. And more investment creates more jobs, doesn't it? Okay, so the spot whereby you have a difference between the depreciation and the capital allowances that give rise to deferred tax. The other one is an overseas dividend income. That goes into PBT on an accruals basis, doesn't it? However, it will only get taxed when it is received, isn't it? So if you accrue it this year but don't receive it until the next year, then there will be a future tax consequence, won't there, next year when we pay the tax on the dividend. But we're going to recognise that tax on the dividend this year because that is when the dividend arises. When I say recognise it this year from an accounting perspective. Don't change the tax that we physically pay. We just change the tax expense based on an accounting adjustment called deferred tax. Still with it? Yeah, it's tough. So what we'll do is we'll go into the next session, which takes an example which ignores deferred tax, and hopefully will make you understand that little bit better, why we go through and use deferred tax, knowing what it's about in a little bit. Okay. So to go through and help us why deferred tax is important, and we need to incorporate an adjustment for deferred tax in our financial statements, we're just going to go through and look at an example that excludes deferred tax. The example that you've got there within the notes is called Tracy. And if we look at what it wants, it importantly says ignore deferred tax. So ignore everything to do with these permanent differences, these temporary differences, and the fact that PBT is not equal to PCTCT. Okay. So ignoring deferred tax, it wants us to calculate the profit after tax. So in order to do that, we need to take profits before tax, we need to work out the tax charge, and then we need to work out your profit after tax, or your profits for the year. And it wants us to do it, is it there for the 3 years? Okay. So as we said, if we're going to go through and work it for X, 5, 6, and 7, you've got the pro forma that you can set up there. We need to go through and work out PBT. We need to work out the income tax expense, and we need to work out the profit for the year, don't we? So let's just go back to the question to try and find out what the profit before tax was. I think it says in that second paragraph, doesn't it, that Tracy made an accounting profit of $2 million. Okay, so if that's the case and we're working in thousands, then we can put in that 2 million as 2,000, can't we? So for X5, for X6, and for X7. Okay. We need to go through then and set up a working, don't we, for the income tax expense. You're unlikely to have to go through and work out the income tax expense using the tax rules that you've seen from F1, but we'll do it here. So what you've got, again, a pro forma for X5, for X6, and X7. And remember, what we do is we take our accounting profit and we add back any disallowable expenses. So here, I think the question talks about buying an item of non-current asset, so property, plant and equipment. We depreciate your property, plant and equipment, and therefore that depreciation is not taxable, is it? Or it's disallowable. So therefore we add back the depreciation, and what we do there is we substitute it with the tax authority's version of depreciation, which is your tax allowance, or alternatively in the UK we refer to it as capital allowances. If you add the depreciation to PBT, deduct the tax allowance, you get to PCTCT. Can you remember what that stands for from those glory days of F1? Yes, it's essentially your accounting, or sorry, your taxable profit, isn't it? Your profits chargeable to corporation taxes, as we call it in the UK. Internationally, I suppose it's your taxable profit. You take that taxable profit and multiply it by the tax rate at 20%. So we need to understand what we have with regards to the depreciation and the tax allowances. So I think Tracy purchased an item of plant at the start of X5, was it there, for $5 million? And it has a useful life of 5 years, doesn't it? So we will depreciate that 5 million over the 5 years. Is that 1 million per annum? I think it is, isn't it? However, the tax authorities don't like depreciation. It's a bit too subjective, isn't it? So they allow us, is it 50% as an allowance in the first year on the cost, and then it's a 20% reducing balance thereafter. Okay, so remember, reducing balance is you apply the percentage to the carrying value, don't we? If we apply that, so get yourselves a blank page of paper or go back to where your workings were. Let's first of all go through and look at the depreciation. Depreciation was nice and straightforward, wasn't it? Again, we'll work in round thousands. We take the 5,000 divided by the 5 years. Simple. 1 million per annum, isn't it? Okay, or 1,000. Capital allowances, or tax allowance, maybe just a little bit more challenging. The cost was 5,000 and we got a 50% allowance in the first year, didn't we? So is that 2,500? Okay, so 5,000 less the 2,500 gives me a carrying value for tax purposes of 2,500, doesn't it? We've claimed our 50% tax allowance in the first year, but we then need to look at what happens in the second year. And in the second year, we got a 20% allowance. 20% on that 2,500. 20% of 2,500, I think, is 500, isn't it? Which then gives me a carrying value for tax purposes of 2,000. But what we need to use in our tax computation are the tax allowances of 2,500 and 500. To work it out for the third year, I think you're probably there already. You may have done it already yourself. We take 20% of, is it the 2,000? That gives me 400 as your tax allowance and your tax carrying value of 1,600. Okay. So the depreciation stays the same every year. The tax allowance varies, whereby we claim much more tax allowances in the earlier life of the asset as opposed to a bit later on, isn't it? We'll see how that impacts tax expense in a moment. So back to the actual tax comp. Let's do each year separately. So for X5, the profits before tax was 2,000, wasn't it? We know that. The depreciation was 1,000, and the tax allowance was 2,500, wasn't it? So we claim a nice big tax allowance in the first year, and because of that, our taxable profits are quite low, aren't they? If we take 20% of that, I think we end up with a tax expense, is it, of 100. That tax expense, where does it go? Yeah, right back to the top, isn't it? And then we put that in our income tax expense. That's our estimate at the end of the year of 100. That would also be your tax payable balance on the statement of financial position. Give me a profit of 1,900. Okay, again, not worried about deferred tax. We're just working out your current tax as we know. Everybody happy with that there? If you're not, stop the video, rewind it, and make sure that you're happy before we then progress. Don't forget, we're going to be doing exactly the same for X6 and X7, aren't we? So for X6, back to our tax comp. Profits of 200, depreciation 1,000. I should say profits of 2,000 and depreciation of 1. You're probably going to have to go back and have a look at your working to find the tax allowance. I think in that second year, it was only 500, wasn't it? I think it was the 20% of the 2,500. That gave me a much higher taxable profit than in the previous year at 2,500, and therefore that gives me a much higher tax expense, doesn't it? Tax expense there, 500. So the 500 is what I would recognise in my statement of profit or loss. Again, the corresponding entry would be made as your tax payable in the statement of financial position as a current liability. And then the profit for the year works out as at 1,500. 20x7, so the final year, profit before tax 2,000, depreciation 1,000, we know that. The capital allowance was very small, wasn't it, compared to both of the previous years? It dropped down to, was it 400? That gave me profits chargeable to corporation tax of 2,600 and a tax figure of 520. So because we're claiming much less of a tax allowance in these later years, we're paying more and more tax, aren't we, as we go along from X5 to X6 to X7. That 520 appears is your tax expense. So if you like journal entries, debiting your tax expense in profit or loss, credit your tax payable on the SFP. So you're going to have a 520 liability on the statement of financial position. Your profit for the year is 1,480. Okay. There we go. We've done all the calculations. It's all correct. What's the problem? Well, you're a manager, you're a director, you're responsible for the earnings of this company. If you look at the profits before tax, how well has the company done each year? It hasn't improved, but it's done equally well, hasn't it, for each of X5, 6 and 7. Yeah, it made 2 million worth of profits. So as a manager, you haven't done outstandingly well, but you've still managed to maintain the profitability. Compare that to the profit for the year. That's your earnings, isn't it? One of the key ratios we'll look at later in the course is your earnings per share. And that's what a lot of directors will get judged on by the shareholders. And if you look at the earnings, what are they doing? Falling. Why are they falling? They're falling because of the tax charge. So as a director, I'd be a little bit upset in that my business has performed equally well in each of the 3 years. But when I look at one line further down, there's problems, aren't there? The earnings figure shows that we are performing worse each year due to the tax expense. Okay, the fact that the tax rules are different to the accounting rules. And as a director, I don't particularly want to be punished for that happening, do I? It's not my fault. I don't create those tax rules. So what we can see there is that the profit is decreasing each year, isn't it? Well, we have performed equally well each year. So that's a little bit unfair. And then the other one, which I think is quite important, isn't it, is that we're not applying the matching concept, are we? You know, if we get the benefit of a £1,000 depreciation charge through my tax, that's what we should expect to see, isn't it? You know, if 1,000 goes through your profits, then we should expect to see the benefits of a 1,000 depreciation charge going through my tax charge, and we don't. Yeah, we have 1,000 depreciation each year, but the tax charge changes each year because the tax allowance is different to my tax depreciation or my depreciation expense. And that's hopefully what deferred tax will go through and adjust for. It will hopefully not distort the profits each year, and also it will ensure that we have the matching concept, so that if we have a depreciation expense of £1 million, we get the tax benefits of that million through our tax expense. So we'll talk about deferred tax in more detail when we look at the example again with deferred tax, having looked at how to calculate it. So I'll see you all in the next video.